Right now, Opendoor Technologies, trading under the ticker OPEN, is priced at $8.67.5. That's a significant intraday jump of over 8.8%, a move that catches the eye on any trading platform, whether you're using a sophisticated setup from interactive brokers or checking prices on the Robinhood app. Now, the immediate reaction, the expectation, is to think this is just another volatile day for a stock that's been on a wild ride, a meme stock caught in the cross-currents of a difficult housing market. Most will see that green percentage and assume it's retail enthusiasm, a short squeeze, or some fleeting reaction to a minor news headline. But the reality of what's happening underneath the surface is far more complex and speaks to a fundamental reevaluation of the entire iBuying model that the market is only just beginning to price in. The real story isn't just today's price action. It's about the massive institutional chess match playing out and a strategic pivot away from the very business that made Opendoor famous. The common narrative surrounding Opendoor for the last couple of years has been one of struggle and survival. The expectation was set. A company built on buying homes with algorithm-driven cash offers would be decimated by soaring mortgage rates and a frozen real estate market. When the Federal Reserve began its aggressive tightening cycle, the consensus was that Opendoor's business model was fundamentally broken. Holding billions in housing inventory on your balance sheet is a fantastic strategy in a rising market. But in a downturn, it's an anchor that can drag you to the bottom. We saw the stock plummet from its highs, nearly getting delisted, reinforcing this belief. Investors, from those managing their own individual brokerage accounts to those using Schwab Intelligent Portfolios for a more hands-off approach, largely wrote the company off as a casualty of macroeconomic forces beyond its control. The story was simple. High rates mean a bad housing market, and a bad housing market means a failing Opendoor. However, the reality hitting the tape tells a different story, one that challenges this simplistic expectation. Today's surge isn't happening in a vacuum. It's part of a broader, albeit choppy recovery that has seen the stock climb dramatically from its lows. The deeper truth is that Opendoor is undergoing a critical transformation. While the market was fixated on the iBuying losses, the company has been aggressively shifting towards a capital-light marketplace model. This is the insight that separates casual observation from serious analysis. They are moving from being just a house flipper to becoming a real estate platform, offering services for a fee rather than taking on all the balance sheet risk. This is a massive strategic pivot. They are building a distributed platform, integrating services like financing and title, aiming to capture revenue from a much wider range of transactions without the immense risk of holding depreciating assets. Recent news about a significant leadership overhaul, including bringing back co-founders to the board and appointing a new CEO with a strong operational background from Shopify, signaled to the smart capital that this isn't the same Opendoor from 2 years ago. This is a reinvention. And the recent surge in trading volume, which has been astronomical, isn't just retail frenzy. It reflects larger players taking notice. We've seen reports of major firms like Jane Street taking a substantial stake. That's not a speculative bet. That's a calculated investment based on a new thesis. Let's drill down into the stock's recent behavior. The volume today is already topping 91 million shares, far exceeding its average. This isn't your typical low-float momentum stock. This is significant institutional interest. Looking at the order book through a platform like Fidelity's Active Trader Pro or the advanced tools at Interactive Brokers reveals large block trades supporting the upward movement. This isn't just a collection of small buy orders from users on the SoFi Invest platform. This is methodical accumulation. Furthermore, the short interest, while still notable at over 20% of the float, has become a double-edged sword. It provided the fuel for a potential squeeze, which attracted momentum traders, but the underlying reason for the sustained buying is this strategic pivot. The reality is that the high short interest created a coiled spring, and the positive fundamental changes, like better than expected revenue beats in recent quarters and a clear path to reducing inventory risk, are what's uncoiling it. The market expected continued cash burn and inventory write-downs. The reality is that Opendoor has been surprisingly resilient, managing its inventory better than anticipated and showing sequential improvements in its contribution margin. This outperformance, however slight, breaks the established bearish narrative and forces a reevaluation. It's no longer just about surviving the housing winter, it's about emerging with a more durable, higher-margin business model. This is the kind of nuanced analysis that's crucial for anyone serious about online investing, whether you're building a portfolio of Fidelity ETFs or actively trading individual stocks. For those less familiar, Opendoor's core business, known as iBuying, is straightforward in concept. A homeowner goes to Opendoor's website, provides details about their home, and receives a near-instant all-cash offer. If accepted, Opendoor buys the house, makes necessary light repairs, and then lists it for sale on the open market. The appeal for the seller is the speed, convenience, and certainty of the sale, bypassing the traditional hassles of showings, negotiations, and potential deals falling through. Opendoor makes its profit on the service fee it charges and any appreciation in the home's value between buying and selling it. This model thrived when home prices were consistently rising, but the sharp increase in mortgage rates cooled the market dramatically, leaving the company holding thousands of homes that were suddenly worth less than they paid for them. This is the history that created the dominant bearish expectation. The company was forced to take massive write-downs and burn through cash. But as discussed, the company is now aggressively expanding its platform to connect buyers and sellers in different ways, leveraging its technology and brand without necessarily putting every home on its own books. This is a critical distinction many investors are still missing, focusing on the past instead of the future trajectory. Looking ahead, the future of Opendoor is a tale of two competing forces. The primary risk, the reality that still looms large, remains the macroeconomic environment. The Federal Reserve has signaled potential rate cuts, and mortgage rates have eased slightly, but they remain elevated. This creates a lock-in effect, where existing homeowners with low fixed mortgage rates are reluctant to sell and move, constraining housing supply. Furthermore, housing affordability is still a major issue for buyers. If the economy weakens and unemployment rises, the housing market could face another leg down, which would definitely hurt Opendoor even with its revised capital-light model. The analyst community reflects this uncertainty, with a consensus hold rating and a wide dispersion in price targets. Some see a path to profitability and significant upside, while others believe the stock is overvalued given the continued losses and execution risk. You have price targets ranging from below $1 to as high as $5, which, even at the high end, is well below today's trading price, indicating a deep skepticism among Wall Street professionals. On the other hand, the potential catalysts present a compelling case, which likely exceeds the market's base case expectation. The biggest opportunity lies in the successful execution of their platform strategy. If Opendoor can truly become the Amazon of real estate, a one-stop shop for buying, selling, financing, and closing, the total addressable market is enormous. A continued gradual decline in mortgage rates through 2026 could slowly unfreeze the housing market, leading to increased transaction volume, which is the lifeblood of Opendoor. Any positive surprises in their upcoming earnings report, particularly about gross margins and progress on their capital-light initiatives, could force a major repricing by analysts. We must also consider the technological edge. Opendoor's pricing algorithms and operational logistics are its core intellectual property. As they gather more data and refine their models, their ability to accurately price homes and manage transactions efficiently should improve, creating a competitive moat. It's a high-risk, high-reward scenario, not unlike early investments in disruptive tech stocks such as Tesla stock or Nvidia stock before their respective sectors matured. It's a bet on a fundamental shift in a massive, traditionally slow-moving industry. To that point, I want to ask you all to comment below. Do you believe the traditional real estate agent model is obsolete, or will it always have a place, despite platforms like Opendoor? In conclusion, the story of Opendoor Technologies is a classic example of expectation versus reality. The end generation was that of a company doomed by interest rates, a one-trick pony whose business model was invalidated by a shifting macroeconomic landscape. This narrative was easy to believe and for a time seemed to be proven correct by the stock's catastrophic decline. However, the emerging reality is far more nuanced and, for bulls, far more promising. We're witnessing a company in the midst of a difficult but necessary transformation, moving from a capital-intensive house flipper to a potentially high-margin real estate technology platform. Today's powerful stock move is not just random noise, it's a signal that the market is beginning to recognize this pivot. The volume, the institutional interest, and the resilience in its operating metrics all point to a story that is much more complex than the simple "housing is bad, so Opendoor is bad" thesis. The risks are still very real, and the path forward is fraught with challenges. But for those engaged in online investing and looking for opportunities where the prevailing narrative may be wrong, Opendoor presents a fascinating case study. The expectation was bankruptcy. The reality could be a powerful comeback story.